Union budget presented on 1st April 2020 introduced many changes. One of the major change was introduction of the new income tax regime. You can now choose from old and new income tax slab rates. There has been a lot of confusion around the new income tax regime. What is it, what is covered under it, and which one to choose. So let's try and simplify it. Here is how the old tax regime is different from the new income tax regime. There are 4 tax slab rates under the old tax regime, whereas under the new tax regime they are divided under 7 income tax slabs. The basic exemption limit under the old tax regime was 3 lakh for senior citizens and 5 lakh for super senior citizens. Under the new income tax regime, the same income tax slab rates apply to everyone. The basic exemption limit is flat 2,50,000 for all taxpayers. The primary point of difference is the ability to claim deductions. You can claim all Chapter 60 deductions under the old income tax slab rates, but you cannot claim any deductions under the new income tax regime. However, you can still claim certain tax breaks like rebate under Section 87A, standard deduction on rent received, retrenchment compensation, incomes like agricultural income, and life insurance income to beneficiary. However, you need to forego deductions like investment under Section 80C, home loan interest, standard deduction on salary, education loan interest, and so on. Lastly, you can set off and carry forward loss from house property under the old income tax rates. Loss from house property is the interest paid on home loan. Under the new income tax regime, you cannot set off or carry forward loss from house property. To understand the impact better, let's look at certain cases. Consider a salaried individual earning income in low income bracket. Let's enter these details in the income tax calculator. Keep in mind these income tax changes will be applicable from 1st April 2020. Choose the financial year as 2020-21. Select your age. Let's enter income details. Let's say the basic salary is 7,50,000. HRA or house rent allowance received is 1,87,500. The actual rent that you pay is 3 lakh in a non-metro city. The other allowances that you receive is 25,500. Let's add savings account interest, which is 17,250. It is very common for salaried individuals to claim Chapter 60 deductions. So let's enter investments under Section 80C, which come around to 2,25,000. Health insurance premium that you paid for yourself and your family, which is 27,500. You will get your income tax liability under the old and new income tax regime. Your gross total income is 7,42,750, which is your basic salary plus HRA minus exempt HRA, which is derived from your rent received, plus other taxable allowances, and subtracting standard deduction, which is 50,000 for financial year 2020-21. Your total income after deductions will come to 5,57,750 under the old tax regime as opposed to 9,80,250 under the new income tax regime. We'll add surcharge and health education cess. This will bring your tax payable under the old income tax regime to 25,000 as opposed to 75,000 under the new income tax regime. So as you can see, the income tax liability increases by nearly 50,000 under the new income tax regime. So for salaried individual earning low income, the tax liability under the new income tax regime increases. Let's consider another case for an individual whose income falls under a higher income bracket. Let's enter income details. We'll take the basic salary here to be 21,50,000. The HRA received to be 4,37,500. Let's say the other allowances are 60,500 and savings account interest 21,250. We'll add chapter 6 deductions. Investment under section 80C would be 2 lakh. Health insurance premium paid would come to nearly 27,500. Let's compare the results. Since tax rates are lower under the new income tax regime, the tax liability might be lower. The gross total income under the old income tax regime would be 26,19,250 as opposed to 26,69,250 under the new income tax regime. We'll add surcharge and health and education cess applicable, which will bring your tax payable to 5,64,490 under the old income tax regime and 5,59,810 under the new income tax regime. Since tax rates are lower under the new income tax regime, tax liability might be lower. This is because the income is now divided under 7 slab rates as against 4 income tax slab rates under the old income tax regime. Let's consider a third case. We'll take a salaried individual having house property losses. We'll take the basic salary to be 9,50,000. HRA received to be 2,37,500. Other allowances to be 25,500. And interest paid on home loan, which will be considered as house property loss, to be 2 lakh. We'll add chapter 6 deductions. 2,25,000 under section 80C. Medical insurance under section 80D to be 27,500. And 1,50,000 under section 80 EEA. Let's look at the results. Your gross total income is 9,63,000, which is your basic salary plus house rent allowance plus other taxable allowances minus standard deduction, which is 50,000 for financial year 2021, and loss from self-occupied house property. This will reduce your total taxable income to be 6,38,000 as opposed to 12,13,000 under the new income tax regime. Since you cannot set off or carry forward losses under the new income tax regime, your tax liability might increase, which in this case increases by nearly 80,000. Hence, the old tax regime might be preferable. Finally, let's consider the case of a senior citizen with having pension income. We'll select the financial year, their age. We'll add income details. Let's say the pension amount they receive is 5,20,000. Savings account interest they receive is 17,250. Fixed deposit interest to be 25,750. Other incomes to be 45,000. Let's go on to deductions. Amount under section 80C would be 1,50,000. Let's consider the health insurance premium paid for self and family to be 32,500. Now let's compare the results. Here the gross total income is 5,58,000 as opposed to 6,08,000 under the new income tax regime. Subtracting the deductions, which will bring your total income under the old income tax regime to be 3,32,500 as opposed to 6,08,000 under the new income tax regime. The old tax regime might be a better option since exemption limit is rupees 3 lakh for senior citizens as opposed to 2,50,000 under the new income tax regime. In addition, senior citizens can also claim Chapter 60 reduction, further lowering their total taxable income, hence lowering the overall taxability by nearly 24,000 in this case. Keep in mind, taxpayers with business income can choose from old and new income tax regime only once. However, they have an option to switch one time, whereas other taxpayers have an option to switch every year. The implications may vary from person to person and different income situations. So let's see which tax regime to choose, old or new. If you are earning allowances as part of your compensation, the old tax regime might seem a better choice, since you can bring down your taxable income. If your salary is tax optimized, the old tax regime might be more attractive. However, if you fall under the higher income bracket, new tax regime could be a better choice. If you have loss from house property, you may continue with the old income tax regime, which allows you to set off and carry forward losses. For a senior citizen, the old income tax regime may continue to be a preference, since the basic exemption limit is higher. Use Quicko's income tax calculator and see which tax regime fits best for you. Subscribe to Quicko's YouTube channel for more such videos. We are Quicko, on a mission to simplify taxes for all.